Okay, let's dive right into this. Welcome to today's explainer. If you're stepping into the market as a first-time homebuyer, seriously, congratulations. It's a huge, exciting milestone. But let's be totally honest for a second. The financial side of things, it can feel completely overwhelming. So today, our goal is to demystify one of the absolute biggest decisions you're going to make during this entire process, and that is choosing between a fixed-rate mortgage and an adjustable-rate mortgage, or an ARM. So, which mortgage is actually right for you? I mean, it sounds like a totally simple choice, but this single decision carries massive weight. At first glance, one option might look, way more attractive. But choosing the wrong mortgage for your specific situation, that could literally end up costing you thousands of dollars down the road, or just create a ton of unnecessary financial stress. And we absolutely want to avoid that. So here's how we're going to break it down. First, we'll look at the dilemma buyers face. Then, we'll get into exactly how fixed rate and adjustable rate mortgages actually work. After that, we'll run through a real-life comparison, and finally, we'll cover some common mistakes and how to make the best decision for you. Section 1. The dilemma. Choosing your path. I want you to picture a really relatable scenario. We've got two buyers, and they're purchasing identical homes for the exact same price, $350,000. They're borrowing the exact same amount of money, too. Literally, the only difference between them is the financial path they choose at the closing table. One opts for a fixed rate, and the other goes for an adjustable rate. Well, fast forward 5 years, and suddenly, their monthly payments look completely different. One is rock solid and stable, while the other has changed dramatically. Understanding the mechanics of exactly why this happens is what we're going to solve today. Section 2. Fixed-rate mortgages, stability, and peace. The concept of a fixed-rate mortgage is beautifully simple. It does exactly what it says on the tin. It's a loan where the interest rate stays exactly the same for the entire life of the loan. So whether you take out a 15-year mortgage or a 30-year mortgage, that rate never, ever changes. And because the rate is permanently locked in, your monthly principal and interest payment remains entirely predictable, forever. And that brings us to the core advantages of going the fixed-rate route. For first-time buyers especially, predictability is huge. It makes long-term budgeting just so much easier because you know your exact costs month after month, year after year. Plus, it acts like a built-in financial shield. If market interest rates suddenly spike in the broader economy, you don't have to care. You are completely protected. Ultimately, the biggest advantage here is pure peace of mind and just greater overall financial stability. Section 3. Adjustable rate mortgages. Lower rates, higher risks. Now, an adjustable rate mortgage, which you'll usually hear called an ARM, works quite a bit differently from our fixed option. Instead of keeping that exact same rate forever, an ARM usually kicks off with a lower introductory rate for a set number of years. You'll often see these advertised as a 5-1 ARM, a 7-1 ARM, or maybe a 10-1 ARM. Think of that initial phase as a safe zone. But once that safe zone ends, your rate is going to adjust based on whatever the broader market is doing at that time. Let's see how this structure actually plays out over the life cycle of a 5-5 ARM. So that number 5 right at the front, that means for years 1 through 5, you have a fixed introductory rate. You are completely safe from any market changes during that 5-year window. But notice what happens in year 6. That number 1 means that after your first 5 years are up, your rate adjusts once every single year based on market conditions. So your little safety period completely gives way to uncertainty. Your monthly payments could suddenly increase, or sure, they could decrease, all depending on the market. So you're probably asking, why would anyone actually choose this? Well, let's objectively weigh the pros and cons here. On the advantages side, ARMs usually start with a lower interest rate than fixed loans. That means you get lower monthly payments right out of the gate. That gives you greater affordability and actually more purchasing power during that introductory period. But the risks are very real. The biggest disadvantage by far is uncertainty. If market rates go up, your payments go up, period. For buyers who are on a tight budget, a significant rate jump at year 6 can create this severe payment shock, bringing on some intense financial stress. Section 4. Real-life comparison, fixed versus ARM. Let's see how these mechanics play out mathematically. But right before we look at the hard numbers, let's compare their core philosophies side by side. Our fixed buyer is basically choosing stability, predictability, and lower financial risk over the long haul. Our ARM buyer, on the other hand, is choosing a lower initial rate and potentially lower short-term costs, but they are accepting a whole lot more uncertainty later on. And I really want to stress this right here. Neither option is automatically the better choice. It 100% depends on how you play your cards. Okay, let's look at the math for our $350,000 homes. Let's say buyer A chose a 30-year fixed mortgage at 6.5%. That means their principal and interest payment is about $2,212 a month. Buyer B, they chose a 5/1 ARM starting at 5.5%, which gives them a monthly payment of just $1,987. So during this initial 5-year honeymoon phase, buyer B is saving over $200 a month. Honestly, if buyer B is planning to sell the home or refinance before year 5 ends, they're saving a lot of money with this strategy. But let's move forward to year 6, the reality check. Market rates have risen. Now, buyer A's rate, still exactly 6.5%, and they are still happily paying their $2,212. But buyer B's ARM, it adjusts to the new market reality, spiking up to 7.5%. Suddenly, buyer B's monthly payment jumps to roughly $2,447. Ouch! If buyer B had planned to stay in this house long term, well, that fixed-rate mortgage would have been the vastly superior choice. Section 5. Mistakes and decisions. Choosing wisely.
So the crucial point here is aligning your loan with your actual lifestyle. You should heavily consider a fixed-rate mortgage if you plan to stay in the home for many years, you prefer predictable payments, and you're working with a strict, fixed household budget. Conversely, an ARM might be a totally brilliant move if you are highly confident you're going to move or refinance within a few years, you're comfortable taking on some financial risk, and you really want to take advantage of those lower payments right now.
To make sure you don't fall into a financial trap, here's a rapid-fire checklist to help you avoid the most common beginner mistakes. Number 1, please, do not just chase the lowest interest rate without understanding the future adjustments. Number 2, if you do get an ARM, never assume today's payment won't change, because it absolutely will. Number 3, always read the fine print on adjustment caps and loan terms, so you know exactly how high your rate is legally allowed to go. And number 4, factor in exactly how long you plan to stay in the home before you sign anything. I want to leave you with this really powerful takeaway from our source material today. There is no universal best mortgage, only the one that best matches your financial goals. Remember, lower initial payments don't always mean lower long-term costs. Sometimes peace of mind is absolutely worth paying a slightly higher initial rate. So as you gear up to make what is probably the biggest purchase of your life, I challenge you to ask yourself this. Are you planning for the next 5 years or the next 30? Truly answering that single question might just save you thousands of dollars. Thanks so much for joining me on this explainer, and hey, happy house hunting.